the 10s, 30s, of course. And that's obviously something a little bit different because we're now going into a fly mode. We're now going into that fly trade narrative. Now, obviously, we could start leaning against that in terms of trade. We could lean against that idea depending upon whether inflation was going up or inflation was going down. But if I now tell you a different storyline, if I now say that this is the 2s, 5s, and if I now say that this is the 5s, 10s, and I now, this is the 5s, 10s, and I now say that this is the 2s, 5s here, sorry, what's the trade now? It's a buy in the 2s, 5s, isn't it? So that's 100% a sell trade in bonds. It's not a fly trade anymore. It's 100% a sell trade in bonds. Well, let's go back to Sam's question about the 2s, 5s. Sam's and Reeves' question about the 2s, 5s at 1 o'clock. Okay, so here's 1 o'clock just in here against, let's get rid of the oil so that we don't have an oil influence on this, because oil was kind of flat. At this stage, the one thing that I can tell is that the overall shape of the narrative is that the 2s, 5s has done very good to the upside, but it's now flat to me. There is definitely a slight upside bias, but it's definitely not moving any further to the upside. The 5s, 10s has exploded during that period. And you can see that the 2s, 5s on the other side of that has obviously dropped off equally to the downside. So at that stage, we have probably a slight bias on the sell side of bonds, yes? Now, as Sam rightly mentioned, there was an upsurge in the inflation expectation measure. The inflation expectation measure is this green line. There was an upsurge in the inflation expectations, but that wasn't being mirrored at that stage by oil prices. Oil prices were actually drifting off. They'd spiked higher, but they drifted back off. Oil prices were actually slightly down during that period. So unless you were expecting to be buying oil, then you'd be looking at the tips expectation and saying, wait a second, these guys are seemingly way ahead of the curve at this point. I'm not sure what their view is, but they seem to be way ahead of the curve. So I'm not disagreeing with the boys about the sell at the top edge. I just don't think it was anywhere near as clear as the sell on the retest. I think the sell at the top edge was a good trade, and I said that at the time that we should be auctioning the rotation on bonds at the present moment. We should be buying and selling bonds at the present moment. So this is good. This is what this conversation is good for, because we can all look at these ideas inside these areas and think about what it is we're seeing and think about what we're going to be doing about it. Some of you guys might zoom out a little bit and say, well, that's absolutely spot on. That's exactly what I'm seeing now, because I can see that the 2s, 10s isn't actually even that steep. The 2s, 5s actually is slightly declining during this period. Sorry, the 5s, 10s is declining during this period. The 2s, 5s is really declining during this period. So this retest on the 10s, 30s is really, really high. So if that retest on the 10s, 30s is really high going into 1 o'clock, that suggests, of course, what? 10s, 30s selling, but possibly against a 2s, 5s buyer. So if the 10s, 30s is going to be a sell, what's the trade on bonds? If you're going to sell 10s, 30s because you think it's maybe a little bit too high, what's the trade on bonds? The trade on bonds is to buy for the squeeze. The trade on bonds is to buy for the squeeze to go higher at that stage. And that's what happened at 1 o'clock. That's why the boys managed to get a sell into 5 past 1, because they got the squeeze on bonds that chart there suggests was going to happen. Now, what I'm saying is, at that stage, it's a good trade, but it's just not a great trade. It's going to get attention because we got a higher price in bonds. But if we move forward a little bit, Look at the difference in that trade now. Look at the difference on that trade right now. Do you see a difference in this trade now, guys? What do you think? 1:30. Now the twos fives is dropping down into the bottom edge. The fives tens is making a higher high print, and the tens thirties is still strong in the background. This to me is a no-brainer trade on the short side of bonds. Now the bond was only trading 28s at this stage, but I just think it's a far safer trade now that the twos fives has given us all the evidence we need for that higher print. So now it starts to stack up for me. Now I'm starting to think about the probability that selling bonds is the best trade on the planet, because at this stage, oil prices are neutral. They've been dropping, but they're kind of neutral now. We've seen a couple of buy-side bounces. That's good news. So we can start to look at that and say, well, let's start thinking about buying the twos fives, which means selling bonds at 1:30. And that sell at 28s drove down to the bottom edges and made a lot of money. So it's all about simply looking at the overall degrees of what's going on, and you can see that that's now turning into what looks like a parallel steepener in terms of equities, in terms of the bond market. Since this point here, it's been parallel steepening quite nicely, in fact. And that parallel steepener is now kicking into some life, because the twos fives has got a lot of room behind that fives tens. But now the fives tens is running out of room against the tens thirties. And then we've got a different question to try and deal with, haven't we? We can look at the inflation expectation, still really bullish. So that doesn't seem to be changing, which means something's wrong with oil prices at this point, isn't it? Something at these low prints is wrong with oil, and we should be able to make money by bidding into any type of opportunity on oil into the lows. So it can get complicated, and what my point, I suppose, about bonds is that if you're not 100% sure, reduce your size, be a little bit more active, be a little bit more aggressive, and when you become 100% sure, then you really explode into trade. The 1:30 trade was 100% correct. The 1:05 trade was probably 80% or 70% correct. So it's just that idea of, just getting the very, very, very best trades against, good trades, but not in the top drawer of perfect trade opportunities. Yeah. I would rather be a little bit late into a trend than get the trend wrong and start getting stopped out on a fade. So I want to make sure I get that read absolutely nailed before I start putting some large cash at risk, which means that you're going to struggle to get rid of that trade if it turns out you're wrong. Because think about it, if you sell into a new high as an institution, if you sell into a new high and you've got your read wrong, I've got to try and buy at higher prices, which is going to find no liquidity at all, and I'm going to be really struggling to do that. I'm going to slip through, and it's going to cost me a very, very sore dent in the bank book. Tend to cash open, guys. 10 minutes to cash open. Sam, you're absolutely right. You're absolutely right. It's just about your perspective on the anchor, doesn't it? It comes back to that concept of getting perspective on your anchoring process. And you know, at that point, it just, to me, it just wasn't quite good enough, because the twos, you know, if you keep going out, the best way you can answer that question is to keep zooming in and out of different time frames and looking at it from different little different levels, starting points and things like that, Sam. You know, when I look at it from any angle, there is definitely a there's definitely a trade in the twos fives, but when you look at it, even going back to yesterday's US session, the twos fives hadn't once even improved. In fact, at that stage, we were sitting in the middle of a 24-hour bracket at that stage, Sam. So whilst we can take bits and pieces of different moves from here to here, for example, or whatever, and the same is true of anywhere, couldn't we? But for me, you know, just seeing that phase there was enough just to make it not a great trade, but a good trade. You know, seeing that the shape of the twos, fives, highs up here, lows down here, highs up here, lows down here. It's definitely more bullish than the twos fives. Absolutely 100%. Definitely more bullish than the twos fives. And because of that, I think you know that we could be bidding into this twos fives at the very, very low price. But the other challenge we've got, of course, behind that is what? What's the other challenge we've got behind that is that weakness in equities, something that Reeve had mentioned he pays a lot of attention to, that I don't pay as much attention to, and I pay more attention to the oil. But if you see that weakness in equities, you'd never have taken that bond trade in a million years, right? Because you'd be looking at that weakness in equities, and unless you are a very, very convinced buyer of equities, you're going to be looking at bonds and saying, wait a second, I think the curve's way too steep up here and needs to work its way back down again. But that's because there's a disconnect between equities and bonds right now, isn't there? That central bank narrative is causing a bit of a disconnect between what's happening on the green line, which is equities, and what's happening on the likes of the blue lines and the black lines and the orange lines, which are obviously the bond curve. So the equities itself is a more difficult trade. So I want to look at the oil at that stage. And the oil confirms exactly what happened in this early stage of back-end curve. But just that weakness in oil, just here since this morning's London Brent Open, just causes enough concern for me to change the quality of the top edge into a good trade, but not a great trade. And obviously that's been my biggest concern with this trade all morning, basically, is the weakness that we've seen in this oil complex just now. And I've looked several times at buying opportunities in oil, and I'm still looking for that perfect opportunity to buy oil, because this is now a big disconnect. This is an inflation hedge that's setting up. This is an inflation hedge that's setting up in here. So it's a little bit confusing. So I think the fact that we're even having this discussion shows that it can be confusing, because there isn't a right and a wrong answer. There's just different views over different time frames. Sam's point about his reference time frame, my point about my reference time frame. It's just about the reference points. It's about what time frame you're looking at. Are you going to try and scalp it for a few ticks? Are you going to try and swing it for a bigger position? Are you going to try and do this or that? It's about reference time frames. And my reference time frame, at the moment, any weakness on the 5s, 10s should be a massive selling opportunity on the 10s, 30s. And if you're going to be seeing a massive selling opportunity on the 10s, 30s, that's going to be a big buy on bonds. It's going to be a massive buy on bonds, in fact, isn't it, at that stage? But that's got to be put into context. If you're going to be buying massively on bonds, does that mean we're going to see a big sell-off on equities? There's a lot of moving parts to this, guys, and you're never going to get a full agreement on what's happening. The one thing I did say was that we'd expect to see a big rally in real yields. What happened to that expected big rally in real yields? if we look at the big rally in real yields, we've been talking up real yields for some time, haven't we? And what happened to the real yield story? Because the real yield story is short bonds. So I want to be in that short bond trade, right? I want to be selling because I know that real yields have to go higher. Let's take a look at it and see if you can see what it is that obviously happened in this storyline. So this is real yields on a 5-minute chart. And if you go back through my thought process on real yields, go back to 11:14 last night and you'll see my thought process here. Look. We did a short above 194 for an amazing short base. I still see banks offering bonds on pullbacks. This is the macro trade. Okay. So this was at 11:14 last night, the 22nd of February, right? So at 11:14 last night, 11:14, which is just in here, I'm talking about real yields being a buy trade for the banks. I'm not talking about it being a buy trade at that stage. I'm talking about it being a buy trade for banks on dips. So when you draw the previous real yield levels, which is something we always have to pay attention to as a bank, then I know that this is going to be a buy opportunity for the bank. I know this is going to be a buy opportunity for the bank here. I know this is going to be a buy opportunity for the bank here, a buy opportunity for the bank here, and a buy opportunity for the bank here. Okay? Anywhere else, you're having to try and figure this out. Okay? So you can already see we've made that trade. Now, what is a buy on real yields? What would you do in bonds if you're going to buy real yields? How do you buy real yields? You sell bonds, right? So if I'm going to buy all of this real yield down here, would I be selling bonds? Well, if you look at what I tweeted, I still see banks offering bonds on pullbacks. Well, that's my trade, that's Sam's trade, that's Reeves' trade, right? So we're all agreeing with each other. The only thing we're disagreeing is whether it was a great trade or a good trade. You know what I mean? Nobody's disagreeing that it was a sell at the top edge. We're just disagreeing whether it was great or good. I said it was great the second time, and I said it was good the first time. So when you see this trade's already been shouted on at 11 o'clock. I still see banks offering bonds on pullbacks, which should cause an uptick in real yields, and this should cap the gold upside. And I talked about that this morning as selling gold on upticks. And that's what's been happening with gold. The gold on upticks this morning has still been in place. You see that we talked about this selling gold on upticks this morning. We talked about these higher prints up here. And gold has been just simply getting annihilated on the sell side. Every time it traded higher, the sells have just kept coming into the gold price, pushing the gold price down. So that little call on real yields, absolutely perfect for any gold trader in that environment. Now, if I overlay this real yield with bond prices, just put on your UB contract here, you'll see what happens. Every time we sell real yields, it should be an almost perfect negative correlation to bond prices. So selling real yields in this phase here, you can see the bond prices at low prints here, so that's not a trade. Selling real yields when bonds are testing into the new highs is a perfect trade. Selling real yields on the spike, perfect trade. Buying real yields, selling bonds there, perfect trade. But that wasn't all we talked about. That wasn't all we were able to tell you about, was it? There was more. Because if you look back through the bonds ever since then, you'll see that we've also mentioned here at 10:15 this morning Our bank volatility model has its needle pointing straight north, so the weakness that we've seen in the S&P was right in line with expectations. The short on the bonds also lines up with a hawkish central bank chatter doing the rounds at the moment re the management of inflation. So that sell on equities and the sell on bonds is explainable from the central bank's hawkish chatter in the background. This is also something that we then made mention. Does anybody remember the chat about China buying oil? Does anybody remember the chat we had about China buying oil as well? In the class this morning, we discussed China's demand for oil and charted the process. We can see that they are not buyers at the moment. They're not buyers. So what does that mean? Well, take a look at what happened to oil since that little tweet. 12:13 p.m. What happened to oil since 12:13 p.m.? Since 12:13 p.m., oil's dropped from 62.20s to 61.20s. Oil's dropped by $1,000. Since we told you China weren't buying oil, oil's dropped by $1,000. Kind of crazy good, right? So what was the next piece of the jigsaw puzzle? Well, real yields. What did we tell you at 146? Real yields, still a lot of upside on the real yield model, which will keep gold capped for the time being. This was at 146, guys. If the bank model and real yields is still to go higher, it becomes very difficult to justify buying bonds at higher prices at top edges. In other words, we're selling into that storyline. So what is our real yield in this trade? What are we saying to real yields here at 146? Higher real yields. So let's take a look at what happened to real yields. So at 146, I've now tweeted that real yield should go higher still. 146, guys, happened to be right here. 146 happened to be right there. There's 146 right there, guys. And then as soon as we've sent that tweet, because that's 145, so 146 is about here on that chart. And I'm saying to you guys at 146, real yields should be going higher at that stage. What happened to real yields? They exploded through to this prior swing high right here, didn't they? And they exploded right through that. So if you look at my model of buying real yield, selling bonds, it's absolutely spot on perfect. Just knowing that real yields has a lot of distance to go to the upside is the perfect trade with the perfect outcome, guys. Anyway, cash open, we've seen selling coming straight in. We've got a little bit of danger below that 50, guys.